$120. That's where silver stood just a few weeks ago. It was the trade of a lifetime. The white metal was finally doing exactly what every believer said it would do. It was going vertical. It was unstoppable. $76. That's where silver sits today. In a matter of days, 37% of the price was deleted, gone, vaporized into thin air. If you held a leverage position on January 30th, you didn't just lose profit, you lost everything. This wasn't a correction. A correction is a cooling off period. A correction is healthy. This was an execution. We're looking at one of the most violent single-day crashes since March 1980. $3.6 trillion wiped from the precious metals complex in the blink of an eye. The charts don't look like a market moving naturally. They look like a crime scene. And right now, you're feeling one of two things. Panic because your portfolio is bleeding out and you don't know if the bottom is in, or confusion because the fundamental reasons you bought silver, the solar demand, the deficits, the inflation, haven't changed at all. So you have to ask the single most important question in finance right now. Is this the bursting of the bubble? Was silver just a hype cycle that ran too far, too fast, and now it's over? Or is this a calculated reset, a trap laid by smart money to shake you out of your position so they can reload for the real run? To understand what comes next, we have to look at why this happened. And I don't mean the headline news. The headlines are lying to you. They're giving you the convenient excuse, not the mathematical reality. If you turn on the financial news, they'll tell you this crash is all about one man, Kevin Warsh. President Trump nominated Warsh as the next Fed chair. The market reacted immediately. Warsh is seen as a hawk. He likes a strong dollar. He hates inflation. He isn't afraid to keep interest rates high. The official narrative goes like this. Trump picked a tough guy for the Fed. The dollar spiked. Traders realized interest rate cuts were off the table, so they sold their non-yielding assets. They sold gold. They sold silver. Then came the jobs report. The U.S. economy added 130,000 jobs in January. Unemployment stayed low at 4.3%. A strong economy means a strong dollar. A strong dollar means weak silver. That's the story they want you to believe. It's neat. It's tidy. It makes sense on a surface level, but it's wrong. News events do not cause 30% intraday crashes in a trillion-dollar market. A nomination is a piece of paper. A jobs report is just data. These things move markets by 1%, maybe 2. They do not cut the price in half. Here's the reality. Here's what actually broke the back of the silver market. It wasn't the president. It was the leverage. Markets run on rules. But sometimes the people who own the casino change the rules in the middle of the hand. While you were watching the news, the CME, the exchange where futures are traded, raised margins. They jacked up the cost to hold a silver contract by 18%. Let me explain what that means in simple terms. Imagine you buy a house for $1 million, but you only have to put down $100,000 in cash. You feel good. You own the house. But then the bank calls you. They say the market is too volatile. They don't want $100,000 anymore. They want $200,000, and they want it by 4 o'clock p.m. today. If you don't have the cash, the bank sells your house instantly. They don't care about the price. They just want their money back. That's exactly what happened to silver. Retail traders were piled in. They were leveraged to the hilt, borrowing money to ride the rocket ship to $120. When the CME raised the margin requirements, those traders got the call. They didn't have the cash, so the computers took over, forced selling. This creates a liquidation cascade. One person is forced to sell. That drops the price. The lower price triggers the margin call for the next person. They're forced to sell. The price drops again. It feeds on itself. It's a fire sale where the sellers aren't selling because they want to. They're selling because they have a gun to their head. This explains the speed. A fundamental shift takes weeks. A liquidation cascade takes minutes. We saw silver drop 10% in 30 minutes. That's not a human decision. That's an algorithm hunting stop losses. So when you look at that red candle on the chart, don't see it as a change in value. Silver is still the same metal it was last week. It's still needed for every solar panel on the planet. It's still in a supply deficit for the 6th year in a row. See the crash for what it is. A mechanical failure, a flushing of the pipes. The weak hands, the gamblers, the latecomers, the over-leveraged retail traders have been washed out. They're gone. And now the dust is settling. The price is hovering around $76. The leverage is gone. The risk is reset. But now we have a massive disconnect because while the paper price of silver is crashing on the screens in New York, something very different is happening in the physical world. The paper market is saying silver is worthless. The physical market is screaming that there isn't enough to go around. This is the divergence. This is the trap. And if you don't understand the difference between the price of a contract and the price of the metal, you're about to get run over by what comes next. You cannot print silver. You can print dollars. You can print contracts. You can print promises, but you cannot print the metal. This is where the game is played. This is the engine of the crash. To understand the trap, you have to look at London. London is the hub of the physical market. If the price of silver is crashing, it implies that nobody wants the metal. It implies there's too much supply and no demand. If that were true, the cost to borrow silver, the lease rate, should be zero. Why would you pay high rent for something nobody wants? But that's not what's happening. While the price on your screen collapsed by 37%, lease rates in London spiked. They jumped. Think about that. The price to buy silver is dropping, but the price to rent silver is rising. This is a mathematical impossibility in a free market. It's a glitch. It tells us one thing. There's a shortage of physical bars. The banks and institutions are desperate to get their hands on the metal even as they smash the paper price into the floor. Here's how they do it. It's called arbitrage. It sounds complex. It's actually very simple. When you panic, you sell your ETF shares. You sell SLV. You sell it so fast that the share price drops below the value of the actual silver held in the vault. It trades at a discount. This is a gift to the big banks. They see the discount. They step in. They buy your shares for pennies on the dollar. Then they turn around and exchange those shares for the physical bars sitting in the vault. They're using your panic to drain the inventory. They're shorting the paper to buy the rock. You sell because you're scared. They buy because they can do math. And this disconnect gets even wider when you look across the ocean. We need to talk about the East-West split. The crash we just watched, that was a Western phenomenon. That was New York and London trading paper contracts. But in Shanghai, the story is completely different. In China, silver is trading at a massive premium. Buyers on the Shanghai Gold Exchange are paying $7 more per ounce than the price you see on your screen. $7. That's a 10% spread. If silver were truly worth $76, why are the smartest traders in Asia happily paying 83? Because they know the supply is gone. They're happy to pay a premium to secure the physical metal now because they know the paper price is a lie. And the timing of this crash, it's not a coincidence. It happened right before the Lunar New Year. China is the world's biggest consumer of raw materials. During the Lunar New Year, the country shuts down. The biggest buyer leaves the room. If you're a manipulator, if you want to slam the price down to trigger those stop losses we talked about, you wait until the biggest buyer's on holiday. You wait until the volume is thin, then you strike. You crash the price while China is offline. You scare the Western retail investor out of their position. You create a fire sale. And then when China comes back from holiday, they step in and buy everything at a discount. We're watching a wealth transfer. We're watching cheap silver flow from weak hands in the West to strong hands in the East. The West sets the price. The East takes delivery. This brings us to the fundamental reality that no margin call can change. The deficit. We're currently in the sixth consecutive year where the world consumes more silver than it mines. This has never happened before in history. Not for 6 years straight. Demand is not shrinking, it's exploding. Solar energy demand is on track to double by 2030. The new solar panel technology, TOPCon cells, uses 50% more silver than the old panels. They're eating the supply. We have low inventories. We have falling mining yields. We have a green energy revolution that's mathematically impossible without silver. And yet, the price dropped $30. Does that sound like a bubble bursting, or does it sound like a spring being compressed? Every time the price drops like this while the fundamentals get stronger, the eventual snapback gets more violent. The spring is loaded, the tension is building, but there's a specific trigger that will release this tension. There's a moment coming in just a few days that will decide if we drop to $60 or rocket back to 100. You need to know what to watch for because the banks are done reloading. They have their cheap metal now. They're waiting for the signal to let it run. That signal is the CPI print. February 13th, mark the date. This is the binary event. This is the moment the market decides if the bleeding stops or if the wound opens wider. The entire crash we just witnessed was built on fear. Fear that inflation is sticky, fear that rates will stay high, fear that the dollar will crush everything else. The CPI data is the truth serum. If the number comes in hot, if inflation is rising, the pain is not over. It validates the hawks. It validates Warsh. It strengthens the dollar. We could see silver retest 68 or even $65. That's the danger zone. But if the number is cool, if inflation is falling, the narrative flips instantly. The fear evaporates. The market realizes the Fed will still cut rates. The dollar weakens and silver, it releases that stored energy. It rips. It's a coin flip. But you don't trade coin flips, you trade probabilities. And the probabilities point to something much bigger happening in March. This is where the James Turk warning comes in. James Turk is a legend in this space. He doesn't look at the noise. He looks at the plumbing, and he sees a clog. We're approaching the March delivery month for silver futures. This is when the paper traders have to decide, do they roll their contracts over to the next month or do they stand for delivery and ask for the actual metal? Usually they just roll the contracts. They kick the can down the road. It's a paper game. But remember the lease rates. Remember the shortage in London. Turk is warning of a potential squeeze. If enough traders demand physical delivery in March, the banks are in trouble. They've sold more silver than they have in the vaults. If they're forced to deliver, they have to go into the open market and buy it at any price. This creates a feedback loop. They buy to cover their shorts. The price goes up. The rising price scares more shorts into covering. The price goes vertical. We saw this in nickel. We saw this in cocoa. When the physical shortage meets the paper short seller, the price doesn't just rise, it teleports. And even if we don't get the mega squeeze, the floor is already visible. Look at JP Morgan, the biggest bank in the bullion game. They're not known for being silver bugs. They're conservative. They're cautious. Their analysts are predicting an average price of $81 for 2026. We're currently trading below that. Think about what that means. The biggest bank on Wall Street, the one with the most data, believes the average price, not the peak, the average, should be higher than where we are today. They're telling you that silver is undervalued. They're telling you the downside is limited. Why? Because of the floor. The floor is not made of speculation, it's made of industry. We're in the sixth year of a supply deficit. For 6 years, we've used more silver than we dug out of the ground. You cannot cheat physics forever. And the demand is changing. It isn't just jewelry anymore. It isn't just silverware. It's strategic. Solar power is doubling. By 2030, the solar industry alone will consume a massive chunk of the global supply. And they're switching technology. They're moving to TOPCon cells. These new cells are more efficient, but they're thirsty. They use 50% more silver than the old panels. These factories don't care about the Fed chair. They don't care about the CPI print. They need the metal to build the product. If they don't have silver, they don't have a business. So when the price drops to $76, they don't panic. They celebrate. They back up the truck. They buy everything they can get their hands on because it's on sale. This industrial demand creates a hard floor. The price can only drop so far before the factories step in and buy every ounce available. We're bouncing off that floor right now. The speculative money has been flushed out. The tourists are gone. The weak hands have folded. What's left is the core, the strong hands, the industrial buyers, the central banks in the East, and the smart money that knows how to read a balance sheet. The crash was the setup. The volatility was the trap. It scared you into selling low so they could buy high-quality assets at a discount. But knowing this isn't enough. You need to know exactly when to pull the trigger. You need to know the specific price level that confirms the reversal has started, because if you enter too early, you catch a falling knife. If you enter too late, you miss the move. There's one chart pattern that tells you exactly when the trap is closed and the bull run is back on. It's called the flush and reversal. And we've seen this movie before. Go back to 2008, the financial crisis. Silver crashed by 50%. It fell from $21 down to $9. Everyone said the bull market was dead. Everyone sold. They panicked. They left the market for good. 3 years later, silver was trading at $50 an ounce. The people who sold at $9 missed the greatest wealth generation event in the history of the metal. They got shaken out right before the payoff. That's the trap. The trap isn't buying at the top. The trap is selling at the bottom because you think the game is over. The game is not over. The board is just being reset. Think about the math of mining. This is the ultimate floor. Right now, at $76, miners are profitable. But if the price stays here or drops lower, the marginal mines stop making money. They shut down. When mines shut down, supply drops. When supply drops in a deficit market, prices explode. It's a self-correcting mechanism. The price cannot stay low because the world cannot function without the metal. We're not talking about gold here. Gold is money, but it sits in a vault. You don't need gold to run your iPhone. You don't need gold to launch a Tomahawk missile. You don't need gold to build a solar farm. You need silver. It's the most conductive metal on the periodic table. It's strategic. It's essential. If the price crashes to $50, the miners go bankrupt, the supply stops, the solar companies panic, the military panics, the price goes to $200. The smart money knows this. That's why they're not selling. They're hedging. They're buying the physical metal in Shanghai while shorting the paper in New York. They're playing both sides against the middle, and you are the middle. So what do you do right now? You have to watch the $80 level. $80 is the psychological line in the sand. It was support. Now it's resistance. The moment silver closes a daily candle above $80, the crash is officially over. That's the signal that the bulls have regained control. That's the signal that the liquidation cascade is finished. Until then, we're in the chop. We're in the danger zone. The February 13th CPI print is the catalyst. If inflation cools, the dollar drops and silver reclaims $80 fast. If inflation is hot, we might test $68. But don't confuse volatility with value. The value has not changed. The deficit is real. The solar demand is doubling. The vaults in London are empty. The $3.6 trillion that vanished from the market didn't disappear. It transferred. It moved from the accounts of the impatient to the accounts of the strategic. This crash was designed to test your conviction. It was designed to see if you actually believe in the fundamentals or if you were just chasing a green candle on a chart. If you're still here, if you haven't sold, you passed the test. You survived the flush. Now you need to prepare for the reversal because when silver turns, it doesn't give you a polite warning. It doesn't send you an email. It just goes. It moves violently to the upside, just like it moved violently to the downside. The recovery will be led by the physical market. Watch the lease rates. Watch the premiums in Shanghai. When those diverge again, the paper price will snap back to reality. But timing that entry is the hardest part of trading. You know why it crashed. You know the fundamentals are screaming buy. But if you buy a day too early, you lose 10%. If you buy a day too late, you miss the initial 20% rip. Understanding these specific indicators, the combination of volume and price action can signal the exact moment the institutions stop selling and start accumulating. For more insights and analysis on navigating these critical market movements, check out Xkane AG.